Hello everyone and welcome to today's NinjaTrader Ecosystem webinar event where we are hosting Steve Rhodes of Mastering Probability. My name is Chris and I'm a platform support representative for NinjaTrader. We have a very special event for you today with Steve Rhodes from Mastering Probability. I would like to mention that it is important to understand that there are substantial risks in trading commodity futures, contracts, or foreign currency. You should carefully consider whether such trading is suitable for you, and this will depend on your specific circumstance and financial resources. It is possible to lose all the funds deposited with your broker, and you could even incur losses beyond these amounts. Please inquire at brokerage support at ninjatrader.com for more information or for a copy of the CFTC full risk disclosure. Also, please remember that these training webinars are not a solicitation nor recommendation, but simply educational in nature. And this webinar today is presented by NinjaTrader LLC, which is a technology company responsible for developing and supporting the NinjaTrader software. Brokerage-related questions should be directed to our brokerage team. You can call them directly or you can email them using the email address that I put in the room. And here is a phone number as well for the NinjaTrader brokerage office. The NinjaTrader ecosystem website is home to hundreds of third-party apps and services, all centered around the NinjaTrader platform. With new tools added to the site weekly, you can quickly search by keyword or by trading methodology, asset class, and more. You'll find more information about upcoming webinars and on-demand webinar recordings on the NinjaTrader ecosystem website as well. So here is a link to the NinjaTrader ecosystem website. For up-to-date information, also be sure to follow the NinjaTrader ecosystem on social media, including Twitter and Facebook. And NinjaTrader is always free for advanced charting, strategy development, back testing, and trade simulation. So if you are new to the NinjaTrader platform, you can get started for free at the link that I'm posting into the room now. This link will allow you to download NinjaTrader for free and also request a free live market data trial. We do also have platform educational webinars throughout the week that'll help you get started and learn more about the NinjaTrader software itself. So the last link that I'll post in the room right now is a link to our schedule of weekly product training webinars. And we are very excited for today's unique event in which Steve Rhodes of Mastering Probability will discuss how to prepare for the potential of a bear market in 2020. Thanks again for your attendance today, and without further ado, it is my pleasure to welcome into the NinjaTrader webinar room Steve Rhodes from Mastering Probability. Steve, you can go ahead and take it away.
Thanks so much for joining me here today. And Chris, thanks for that introduction. Great to hear that the majority of the participants are here for education. It's going to be a great educational session of about 30 minutes or so. The way that I'd like to be able to work this, folks, is if you got questions, go ahead and post them into the chat room, and I'll either try to integrate those answers or responses to those questions as the workshop goes on, or we'll just simply try to take each and every question at the end of the workshop. So before we get going, a little housekeeping on my end, the legal disclaimer: trading in securities such as stocks, options, indexes, currencies, and futures involve risk and should not be undertaken without due diligence and serious independent study. Options, stocks, currencies, and futures trading involve substantial risk. Subscribers and attendees of this workshop may carry out their own trading based upon what they learn from this workshop hosted by me, Steve Rhodes. However, all risk of potential financial losses are the subscribers or the attendees' responsibility. Steve Rhodes, myself, I will not be liable in any way for financial losses resulting from trading decisions based upon this workshop or any other advice. Past performance is no guarantee of future results. Reproduction in whole or in part not permitted without prior written consent. Copyright 2020, all rights reserved. So, studies show that we make decisions about people within the first 6 seconds. That's right. We never have a second chance to make a first impression. So here goes my attempt to make a good first impression. 2020 is shaping up to be the year of the bear. Pretty amazing to say that. We're at all-time highs today. But but you're going to see that the tools and the techniques that I use out here, that at this moment in time, it appears that 2020 is shaping up to be a bear market. But we're going to let the market tell us what it's going to do. And I'm going to show you the one pattern. I'm going to show you two patterns, but I'm going to show you the one pattern that has been present before the beginning of every Dow bear market and how you can time it. You see, I'm a market timer, and I want to be able to teach you how to time. And I'm very good at timing the markets. Timing is absolutely everything. Now, when I say I'm good at timing, in 2018, I was recognized by Timer Digest as the Market Timer of the Year. Now, Market Digest tracks about 100, 150 newsletter writers from across the globe. And stacked up against them, I outperformed them substantially in 2018. The 2019, as of December 21st in 2019, I was still in that lead spot. As it turned out, for 2019, I ended up finishing second amongst all of my peers out there. Now, when I say second, I would have been in first place if the S&P 500 had closed 1.5 points higher on December 31st out there. That's how close the race was. It went to decimal points. But I want you to also have my contact info. Now, I don't say that to simply impress you. I share that with you because the tools that we're going to take a look at and use today are the exact tools that I have used for that market timing. So if I can do it, I guarantee you that you can do it. And I'm not here to kind of bait you along. I'm here to show you the tools that I use. Now, we have a limited amount of time, but I have ways for you to be able to continue that education. And so many of you were here to grab an education, and I would think you might want to utilize the tools that I'm using in addition to your own to help time the markets. Now, a bit about my background. I'm a bean counter by education. I was licensed as a certified public accountant, a CPA. I can cut, paste, and assemble as good as anybody in the state of Michigan and the state of Florida. I'm actually coming to you live from Delray Beach, Florida. I live in Delray Beach. For those of you not familiar with it, it's down southern Florida in Palm Beach County. I used to be an owner and operator, so I didn't really practice accounting, so to speak. I more used it as my business background. I'm an entrepreneur. I used to own and operate retail stores at all the Disney parks, Disneyland, California, Disney World, Universal Studios in the U.S. and Japan and so forth. I sold that business years ago. I'm also a financial talk show host. I have a show that is distributed by the folks at tfnn.com. I do a show each day from 1 to 2. It's an interactive show. In fact, if you were to type in, the name of the show is The Trader's Edge. If you were to type in The Trader's Edge and Steve Rhodes and TFNN, you'll probably see about 8,000 videos that'll pop up. It's an interactive show. If you type in today's date along with that information, you'll see a YouTube video. Now, the worst trading advice that I ever received was buy low and sell high. You see, this is a weekly chart for the Dow, and it shows plenty of buy low opportunities as price moved lower into March of 2009. So how do we know which low to buy? And how do we know which high to sell? Now, when the Dow topped in 2007 and when the Dow bottomed in 2009, it formed what I refer to as a RMI pattern. Now, I know you're going to ask, what's an RMI pattern? RMI stands for Rhodes Momentum Indicator. My last name is Rhodes. It's the Rhodes Momentum Indicator, which is a 5-step process, and I'm going to take you through each of those 5 steps. It's a 5-step process that identifies tops and identifies bottoms. Now, this pattern that we're going to be taking a look at has been present before the beginning of every single bear market since 1889. Now, this topping pattern is currently present. And if confirmed, it should signal the beginning of a 2020 bear market that could last until October 2020, so October of this year, or January of 2021. Now, my outcome today is to share with you 2 patterns. We've talked about, or I've mentioned, the Rhodes Momentum Indicator pattern. I also want to be able to share with you another pattern that helps us identify and spot tops and bottoms. And that's called the TD9 count. Now, these 2 patterns, they work to identify tops and bottoms, and they work for every instrument and for every time frame. And, quick word about NinjaTrader. I have been using the NinjaTrader application for over a decade now. I would not trade without it. NinjaTrader doesn't pay me to say that for you. They didn't even know that I was going to say that for you. But for those, it is a fabulous trading application. I cannot imagine trading without it. It's been great for me to be able to integrate, develop my own tools and integrate those into the system. It is very easy to do, and you've got access to so many resources to assist you with doing that. So again, these are patterns here that help us identify tops and bottoms. And this doesn't mean that these patterns are present at every top and every bottom for everything that you trade. Instead, what it means is that when these patterns are present, a top or bottom is more likely to form. So for example, when the Dow produced a bear market correction in 2000, bear market correction in 2007, a bear market correction in 2018, it was the Rhodes momentum indicator pattern that signaled that top. In fact, the 2015 Dow consolidation also was formed or was preceded by a Rhodes momentum indicator top. Now, for an RMI, Rhodes momentum indicator top or bottom to form, price must be moving higher with less relative strength, or it must be moving lower with less relative weakness. Now, the indicator that I use, the indicator that we use to determine strength or weakness is the relative strength indicator. And that's an indicator, it's a tool, it's available to all of you on your NinjaTrader application. So when price is moving higher with less relative strength, so just take a look at these red arrows up at the top in the price section. Down below that is the relative strength indicator. So when price is moving higher with less relative strength, it signals a potential Rhodes momentum indicator top. So just basically by moving higher with less relative energy or moving lower with less relative weakness, that alone doesn't identify it as a top or bottom. Remember, this is a 5-step process. I'm going to take you through those 5 steps. Now, the confirmation of a Rhodes momentum indicator top occurs, we're talking about tops, our focus right now is primarily on tops because of the potential of a bear market. I want to be able to show you how to spot that, how to look for that, so you'll know when it's going to occur. The confirmation of an RMA top occurs with a bearish reversal candle. That is how the market communicates to you and I that it's ready. At least this is a way that we know after a pattern has completed or is forming that, in this case, sellers are ready to take their position. So Japanese candlesticks are the trigger that'll confirm either the top or the bottom. Now, with regard to tops, there's 13 different Japanese candlesticks. And I'm big into using Japanese candlesticks. But for me, their meaning is at the completion of a pattern. In the middle of a pattern, it's just kind of like reading a book, and that was an interesting chapter. But it's nothing that you could trade on. If you went long on every hammer or went short on every shooting star, you'd get crushed. I know because I've run the statistics on that. But there are 13 bearish Japanese candlesticks. There's also 2 neutral candlesticks. Those 2 neutral candlesticks are your doji and your high wave candle. There's also happens to be 13 bullish Japanese candlestick patterns. So you can see each of those here. And understand, I can't go through the entire Japanese candlestick workshop, but I do have one that's available if you'd like to be able to access that. So, but when markets form tops, this is what I really want you to understand. And remember, this is going to work for every time frame. This happens to be a weekly time frame chart right now that we're looking at. But when markets form tops, it's not the first high that matters. It's the second high and the relationship between time, price, and its relative strength. I want to be able to explain that to you. When markets form bottoms, it's not the first low that matters. It's the second low and the relationship between time, price, and its relative weakness. So the first high that I'm referring to for a top is the high that's associated with the highest relative strength index reading above 69. So 69 is, and that's a bottom panel. Typically, you'll see the relative strength. Most people will look at it when price is above 70 or below 30, and they'll refer to them as overbought or oversold. I don't want to get into that. I instead want to show you how to use a set of tools that'll help you to identify when a market is preparing to make a high or a top or a bottom. So as an example, here is a 30-minute time frame chart for the ES Mini. So now I've gone from a weekly chart of the Dow to a 30-minute time frame chart for the ES Mini. It wouldn't matter what we pull up, if it's a currency pair, it doesn't matter, and it doesn't matter the time frame. But you should continue to always trade within your time frame. So at 10:30 in the morning on December 12th, the 30-minute ES Mini generated an RSI reading of 83.54. That's where that red arrow is on the bottom panel of my screen. Now, by 6:30 that evening, the ES was trading above the high that was generated at 10:30. So let's step back for a moment. Take a look at the highest RSI reading. We've got that pinpointed here. You can see the red arrow. And then we go and we take a look at what was the highest reading. What did the ES trade to at the point in time when we have that highest relative strength reading? That's our first high. It's not the first high, but the first high can be the setup. It's really about what comes after that high. And so if price begins moving above that first high with less relative energy, as you can see down here at the bottom, price is moving higher up top. The relative strength indicator is making lower highs. That is your first indication of a divergence. Now, price moving higher with less relative strength is only a problem when a bearish reversal candle forms, such as in this case here, it was the bearish engulfing candle. In fact, we had two of them. These lines, this is a automated tool that I have had written for me in NinjaTrader, and this little diamond, if you can slightly see it, on the left is where that pattern begins, but this pattern only is going to mean something to your eye when we see it confirmed. And that first element of confirmation for a top is going to be a bearish reversal candle. We looked at 13 potential bearish reversal candles. And Japanese candlesticks are the confirmation of a top or a bottom. So let's review that 5-step process. Step 1 of the Rhodes Momentum Indicator topping pattern is the process begins when the RSI closes above 69. So here, back in August of 1928, the RSI closed over 69. So that is step 1. Step 1, when the RSI closes above 69. By the way, the Relative Strength Index was introduced in 1978. It was developed by a man named J. Wells Wilder. It's a great book, New Concepts in Technical Trading Systems, easy read. I recommend everybody read that. I don't want to get into the weeds here on the on how it's really developed, other than to tell you it's a ratio between the average points gained during up periods divided by the average points lost during down periods. Now, in your relative strength indicator tool, the default setting is 14. So you're using 14 days, in essence, to generate your relative strength indicator tool out there. I use the 14 days. There's no reason that you need to change that. Let's talk about step 2. Step 2 of the Rhodes Momentum Indicator pattern is we wait 5 bars to form after the highest relative strength level is achieved. We want some time. So if it happens on the second bar, that doesn't work for us. We wait for 5 bars. Here is when, in August 1928, the RSI closes above 69. But it doesn't make its highest high until this candle right here. Looks like maybe it's December. I apologize. I don't have the month out there, but you're looking for that highest reading out here. And then from there, we're going to wait 5 bars. If it's a monthly chart, which this is, we'll wait 5 months. If it's a daily chart, we'll wait 5 days. If it's a 30-minute chart, we'll wait 150 minutes before we start to see this pattern form. So we wait 5 bars from the highest RSI level out there. Step 3 of this pattern is once that 5th bar is formed, price must be making a higher high. It's possible you'd have 5 bars later and you're not at a higher high. Well, then you don't have this pattern that is setting up. So you need to have price make a higher high than the high of the bar that had the highest RSI reading out here. So hopefully this chart here shows that to you. It should show you that to you. That is going to be step 3 of this pattern. Step 4 of the pattern is a bearish candle must form. Well, here on that monthly chart, this is before the crash of 1929. There was already the indication that markets were going to move lower. Now, this pattern is present at those highs. Not each pattern that is present is going to lead to a bear market. That's going to be another step-by-step process. But when you do see the pattern confirm, you should be anticipating that price is going to move lower. You need to be able to identify where support is, or if price is going to move higher, where resistance is at. And I can show you how to do that as well. Now, remember, we were talking about these patterns need to be confirmed with bullish or bearish reversal candles. In this case here, we're talking about tops. So even though I showed you 13 bearish reversal candles, 2 neutral candles out there, the ones that are circled, there's 7 of them. Those are the candle sessions that I use to confirm these patterns. So at the top, I'm using a shooting star. I'm not using a hanging man. I'm not using the bear counterattack. I'm not using the bear harami. But I am using the bearish engulfing, the dark cloud cover, the bear sash, the bear separating line, a gap, which is a falling window, or the evening star pattern. So those are the 7 patterns that I use to confirm tops. And the opposite, I would have 7 candles that I use, or candle patterns that I use to identify bottoms. Now let's take a look at step 5. Step 5 of the Rhodes Momentum Indicator pattern is price must close below the Oscillator Unchanged Line. That's this red line that shows up on my screen out here. Now, the Oscillator Unchanged Line identifies the level that price needs to trade below for its price oscillator to signal that it's falling. Now, some of you might say, well, that was a mouthful. What the heck does that mean? First, the price oscillator is measuring the difference between 2 moving averages. Many of you have a MACD tool, moving average, convergence, divergence. You can use that as long as that tool, and in NinjaTrader it does, it allows you to use exponential moving averages. Now you might ask yourself, what moving averages am I using? Those of you that are already familiar with NinjaTrader, you can see what I'm using is the 19 and the 39 period out here. Now the Oscillator Unchanged Line, again, this line here is going to tell me whether I have a rising price oscillator or a falling price oscillator. So how do you know when a retracement is just a retracement and just pulling back to support? Well, that's what this line is all about, the Oscillator Unchanged Line. Now, due to time constraints, I can't go through all the details of the Oscillator Unchanged Line. However, I've got a 1-hour workshop that goes through the entire details of this tool, and you will want to understand that tool. And if you would like to pursue that education and learn the exact tools of that, then just simply subscribe to my newsletter service for free. You have a 14-day free trial. There's nothing charged to your credit card. You've got no risk whatsoever. You get a 14-day free trial to my newsletter service. We're going to continue on with the patterns out here. You get access to a 90-minute money management workshop. You get a 60-minute workshop, the 5 reasons traders and investors fail to spot bear markets, which is really going to take the Rhodes Momentum Indicator pattern that we're taking a look at today and really expand and expound upon that. And then you're going to get the 60-minute to 1-hour workshop on the Oscillator Unchanged Line, as well as if you are a subscriber, you're going to get direct access to me either via Skype or cell phone, and you can sign up at Mastering Probability. This right here, here's the homepage for Mastering Probability. Just click on the risk-free trial out there. It'll take you to the sign-up page, subscribe, and again, you've got a 14-day free trial to Mastering Probability and a number of archived workshops that are available to you. So I'm just logging in just so I can, just in case some of you might take the action right now or this evening to sign up. Once you do sign up, there will be, and you log into your account page, you will then see in the right-hand corner, you'll see subscription links to the newsletter service. That's Mastering Probability. The workshops are going to be under archive webinars by Steve Rhodes, and you'll see the different workshops that are available to you. So and I hope you'll take advantage of that, because I really would like to teach you additional tools. These are tools that help me to become the #1 timer across the nation based on the rankings from Timer Digest. So let's review that 5-step pattern that will help you spot the next top in whatever it is that you trade. Step number 1, the process begins when the relative strength index closes above 69. Step 2, we wait for 5 bars to form after the highest relative strength level is achieved. Step 3, on bars 5 or more, the divergence signal line. So if you're subscribing to my newsletter, you'll see these tools, you'll see these on the charts, but it gets drawn. So whether you do it manually or however, but it gets drawn when price moves above the high of the price high established by that highest RSI reading, as long as the RSI reading is below that highest RSI reading. Now that's a mouthful, but visually you saw that on the chart. Step 4, a bearish reversal candle signals a potential top. Step 5, a close in price below the Oscillator Unchanged Line confirms that top. Now we're focused here on tops because of what it is that I'm seeing in the markets as we speak right now. But for bottoms, you just flip it. The process begins when the RSI reading closes below 31. So I use 31 and 69 versus 30 and 70 out there. Now, my newsletter service, I mentioned this here, the Mastering Probability newsletter is tracking instruments for various time frames to make us aware of the Rhodes Momentum Indicator signals that are present. And here, this is a recent snapshot here. If we take a look at what's going on amongst most of the cash indices on a daily basis, what's going on a monthly basis, take a look at the sectors inside the S&P 500, take a look at some of the equity futures contracts, what you're going to see are topping signals all over the place. And they still exist today, and some new ones formed today, even with price moving higher. Now, if you were to ask me, if you were to say, Stevie, if you have to choose just one pattern to trade, what would it be? Well, my answer, the one pattern that I would trade, and I've got many, the one pattern that I would trade is the Rhodes Momentum Indicator top and bottom pattern. Maybe some of you recognize this character on the screen. That's not me. That's Curly from the movie City Slickers. If you remember that movie, you might remember the scene, right, where he says, you know what the secret to life is? One thing. Just one thing. Once you figure it out, you stick to that. Everything else doesn't mean anything. That's coming from Curly. You know what? I feel exactly like Curly does. If there was just one pattern that I had to learn, this would be the pattern because of its consistency out there. You've got my email. Feel free to email me anytime. If I don't return your email for some reason within 24 hours, please reach back out to me because something would have happened in the email system out there. Look, before the 87 crash, a Rhodes Momentum Indicator signal was warning the bulls. I didn't draw these lines in, folks. These lines take my pattern, take my rules with inside NinjaTrader. It's a custom indicator that I've built, and it just simply begins drawing those lines. And the bearish engulfing candle that formed out here in 1987, right up here at the highs. You see the pattern started forming where that diamond is at, but that doesn't mean that that's a top. You see the next line where price makes a higher high. That doesn't mean that's a top. This red candle right here, that's not a bearish reversal candle. Price is going to continue to move higher until we see the sellers show up. And in this case here, in 1987, before the crash of 87, we had topping signals well in advance. This is a weekly chart for the Dow. If we take a look at the top that was formed, we sort of reviewed that. Again, before the crash of 1929, a Rhodes Momentum Indicator signal was present. So here's what we learned so far. The Rhodes Momentum Indicator pattern has been present before the beginning of every bear market for the Dow since 1889. RMA tops form when price moves higher with less relative strength. RMA tops are confirmed with a bearish reversal candle. RMA tops form when price moves lower. RMA bottoms form when price moves lower with less relative weakness. RMA bottoms are confirmed with bullish reversal candlesticks. The RMA pattern is a 5-step process. You can learn all the details of this 5-step process by signing up for a 14-day free trial of my daily newsletter service. You can do that by going to masteringprobability.com. Now, a few minutes ago, I stated that if the current RMI signals are confirmed, it would signal the beginning of a bear market. That should last until October 2020 or January 2021. So how did I develop those target dates? Where did I pull those out of? October 2020 or January of 2021? Those target dates are derived from the annual seasonal cycle for the Dow that has formed over the last 86 years. So I've taken all of the data for the last 86 years in the Dow, averaged it out by day, came up with those averages, was able to reprogram that and upload that into NinjaTrader so that I could create a NinjaTrader chart so that I knew what was happening on average. So where those dates come from, the market typically forms a bottom the end of January. There's typically a pullback that begins around January 6th. We're now a couple of days after that. These patterns don't always occur, or these cycles don't always. I use these cycles as guidelines versus expecting and anticipating something to happen to the day, although I have seen where it does happen to the day. But typically we see a top form in the early part of January, price moves lower into the end of January, and then we have our big run up into the May and then July timeframe, and then a nice move down into October. So if there is a top that does form out here, and we see price moving lower into the end of this month and early February, and you don't see it stopping, well, now you'll know that that normal pattern isn't in place, cyclically speaking. And this is where I come up with it. So if there is a top that forms out here, I would expect that the markets would move down through October of this year, or possibly January of next year. And that's where those dates. Now, if we're going to experience another bear market, it needs some type of sustained event that erodes confidence fundamentally. What are the things that are in play here in the U.S.? Well, we've got the elections. What are things internationally? We've got Brexit. We've got impeachment here in the U.S. We've got the repo crisis that is ongoing every single day. The Fed is pumping money to cover what primary dealers don't want to get involved with. I won't get into the repo crisis. Then we got a question mark. Well, how about a war? How about a war? Wars have significant impacts on the market. On Saturday, I'll put together a special report and send that out to subscribers. This will be a set of charts that you absolutely want to have, but there needs to be some type of fundamental sustained event if we're going to have a bear market. And if we're going to experience that, technically what we will see is we should see a confirmed Rhodes Momentum Indicator pattern up at the high, combined with a spot VIX index that's trading above its 50-period exponential moving average. That is the bottom portion of the screen. If you take a look at the 2007 top, it forms and it completes with a three-river evening star pattern. We can also go take a look at the spot volatility index. The blue line is its 50-day, or its 50-period, not 50-day, but 50-period. This is a week, so it's a 50-week line out here. And it likely will be it'll likely be the combination of those two. Also, when we do see the next bottom out here, we should see the exact opposite pattern. In that bottom, what we'll see is a Rhodes Momentum Indicator bottom pattern. By the way, this is the March of 2009 bottom, and we'll start seeing the spot VIX index trading below its 50-day exponential moving average. Now, look, folks, I'm not here to scare you. That's not my style. That's not my tactic. Instead, I'm here to prepare you for the next bear market whenever it forms, and exactly what you should be looking for, as this pattern has not changed for the last 130 years, let alone just simply being able to use this pattern intraday for whatever it is that you trade. If you're trying to identify why did the market top where it did or why did it bottom where it did, this is a pattern that you most certainly want to learn. Now, look, another key pattern that I'd like to unlock for you today is referred to as the TD9 count. And this is a great pattern for identifying potential tops and bottoms. Plus, it provides us with key breakout and key breakdown levels. So welcome to the power of 9. You see, when light sweet crude topped in 2011, it formed a TD9 count top. And when it bottomed in 2016, it bottomed with a TD9 count. Now, the TD9 power of 9, or I should say the TD power of 9, consists of 9 consecutive closes less than or greater than the close 4 trading bars earlier. Now, when a 9 count forms, and we're going to go into that, I'll show you the details. When a 9 count forms, the market typically experiences one of 3 things, either a trend reversal, a price hiccup, or a consolidation period. And it commences typically either on the bar before, that'd be bar number 8, the bar of, that would be bar number 9, or the bar following the completion of bar number 9. And we're always comparing close versus close. And this is a tool that was developed by Tom DeMark, just one of his tools. Now, the same monthly chart for light sweet crude without the wicks of the Japanese candlesticks looks like this. Remember, we're comparing close to close. So I'm comparing the close of bar number 9 to the close of bar number 5, or the close of bar number 8 to bar number 4, or bar number 7 to bar number 3. It's always the bar 4 bars earlier. So in this case here, here's a TD9 count top, because as we take a look at bar number 4 versus bar number 0, we've got a higher high. 5 minus 4 is 1. You can see the close. Here you can take a look at 6 versus 2, 7 versus 3, and that's what creates the TD setup 9 count pattern. So to begin the count, again, we're comparing each close to the close of the bar 4 bars earlier. So here is a TD 9 count for the XLP daily basis on the way down. And so I'm comparing this bar that's labeled number 1 to the bar 4 bars earlier. Here's the close. You can see it. It's the bottom of the candle. By the way, on a red candle, the bottom of the candle, red-bodied candle, is the close. On a green-bodied candle, it is the high of the bar. So here we're comparing bar number 1 to the bar 4 bars earlier. 1, 2, 3, 4. Everybody can do this. This is a pattern that everyone can do. You don't have to necessarily have an automated tool unless you're using it for intraday and so forth, or for other things. But that is where we begin the process. Then we go ahead, once we have that in place, well, then we're comparing the next bar, bar number 2, to the candle close 4 bars earlier. 1, 2, 3, 4. We've got a lower close. It gets labeled with number 2. We compare 3 to the bar 4 bars earlier, right? So you've got 1, 2, 3, 4. Okay, it confirms another lower close. That becomes our third. Comparing bar 4 to the bar 4 bars earlier gives us bar number 4. We've got bar number 5. We have bar number 6. We're doing the same thing over and over again. We get to bar number 7. We take a look at bar number 8. We're comparing the close of bar number 8, that's up here around the $50 level, to the close 4 bars earlier around the 52 area. And then finally we have bar number 9 that forms. The close around 50.50 versus 51.20, somewhere. Well, I'm sorry, bar number, 50.50 versus bar number 5 around 51 and change out there. Now, once we identify bar number 9, we've got the TD power of 9, a potential bottoming pattern. So the actual chart for the XLP with the actual wicks looks like this. Again, when a TD setup forms, the market typically experiences one of 3 things: a trend reversal, a price hiccup, or a consolidation period commencing either the bar before, the bar of, or the bar following the completion of bar number 9. So the TD power of 9 lets you anticipate the market's next move. So my newsletter service, Mastering Probability, in addition to showing Rhodes momentum indicator signals, I also am tracking, I'm automatically tracking the TD 9 counts. And I'm doing it for the daily time frame, the weekly time frame, the monthly time frame. Those boxes that are highlighted here are telling us that in the case of the TD 9 counts, they're telling us that we have active counts to be aware of where there could be a potential top or there could be a potential bottom. In this case here, these are all showing us topping signals. So not only do we have Rhodes momentum indicator signals, we've got TD 9 counts that are present in the market. Now, the TD 9 count also provides us with powerful breakout support and breakdown resistance levels. And this is really a cool tool. This is really important for you to understand. So we're not just using this tool to identify potential tops and bottoms. We're also trying to understand, where did price break out of? Where was the breakout, or where was the breakdown? And the breakout, in this case here, around 25,978, right here in the September timeframe. This is for the Dow Jones. It's a daily chart out here. So we're going to take a look at that. That was formed by the low of the 9 count pattern. Well, that happened to occur on bar number 3. Now, when price, likewise, we take a look at over here on the left, 27,281.65. There was a 9 count that formed in the Dow. That, the highest high of that count, it did happen to be here on bar number 3 as well. Coincidence, I suppose. That was resistance. So take a look what price does here in the Dow. The Dow actually makes a 9 count, and it makes it right up to resistance, 27,281, where it proceeds to break down again. And it breaks down again and moves to where? To support. See, a lot of folks used to think that where support, breakout support or breakout resistance would be at a swing point. Now, you may not know what a swing point is, but it would be, in this case here, a swing point low would be the lowest low where before you would see price start to move up. And so many folks would think, hey, it's this bar right here that's your breakout. Not using the TD 9 count, and not with my experience in looking at thousands upon thousands of charts with this pattern. Take a look at what happened here in December. price in the Dow moved right back to support. So it's really important to understand support and resistance in the marketplace. And the TD Power of 9 is one tool, and it's a great tool that allows us to do that. So subscribe to Mastering Probability today. Your members page will provide you with access to this 1-hour TD9 account workshop. You do that by going to masteringprobability.com. It has been great to be with you. I hope that this is a good beginning to 2020. By the way, Happy New Year to everyone out there. You know, I simply love to educate. Are there any questions? Folks, anybody have any questions out there? Chris, I don't see anything. Do you?
Nope. I see the same thing that you do.
Wow. I could not possibly have been that good with that complicated, with that amount of complicated information. The question here's one from Jeff. Are we at a top in the ES Mini? The answer is no. So you missed this presentation. I know it will be archived here soon, and you'll get access to that. And but with regard to this pattern, it's got a potential topping signal, but not until we see the first bearish reversal candle inside the ES. As long as this pattern is still out there, will we be at a potential tops? More details on the subscriber service from Craig Kendall. Craig, it's really very simple. Just come over to masteringprobability.com. That is this is the website. Come over to the risk-free 14-day free trial, and you will start receiving newsletters. I do typically 2 newsletters each day. I do a newsletter in the morning, and it goes out by 9 o'clock, and it gives you, and it's going to share with you exactly what the markets have been doing overnight, what's going on in the futures markets. It's going to cover commodities. It'll cover the trades that we are in, all types of things. And then in the evening, this evening, I'll be doing a newsletter. I typically do Monday through Thursday. I do evening newsletters to let you know what the market did and if there's any signals overnight as to what to anticipate with regard to futures and so forth. So really pretty easy there. You've got a 14-day free trial. There's no risk to you in there. My indicators are in NinjaTrader, Robert. All these charts that you and I have looked at here, they're all NinjaTrader. They're all tools that I have developed in the NinjaTrader application. It's one of the reasons why I love NinjaTrader so much. It is, I just think it's the best charting application that's out there. And so if you're new to it, this is the best place to start. And if you're new to it, I am a pattern recognition individual. And to me, patterns are the stock market is full of just individuals who are trading. Each of us, we probably wake up and we do the same routine every morning. And we probably eat the same dozen restaurants. We each have patterns out there. And so do traders and investors. That's why this pattern that we're taking a look at that has worked for 130 years and will continue to work for the next 130 years is because these patterns are not going to change. And so this is a great tool to use for whatever it is you trade, for whatever time frame it is that you might trade. As far as what time frame works best to determine tops or bottoms, the pattern itself is doesn't care. It's going to take longer to form on a monthly chart than it is on a daily, than it is on an hourly chart out there. So it's just the time frame of what you trade can be noise. If you're a long-term investor, you're really primarily looking at monthly charts and information out there because daily is going to be a lot of noise, and you don't want to get knocked out because of noise, and you want to stay inside your time frame. Seems like you are more longer-term direction with your indicator. I'm not sure how to read that and what you mean. I take a look at each chart. So one of the good tools, one of the good things that each of you can do, as I mentioned, I must have 10,000 video from each of the shows. So the shows that I do each day, which you can see through tfnn.com. You can go to YouTube. If you type in Steve Rhodes, Trader's Edge, TFNN, you'll see all kinds of daily radio shows. Put in today's date, and you'll see today's date. You'll see today's a great example of the show. I have people that call in and ask questions, or I have people that send me emails that I review during the show, and it's for all different time frames and all different types of instruments out there. Are they better for option trading when futures? Is this better for option? You can use this for options trading. Because, let's say you're going to try to, depending on what it is you're doing with regard to your option trade, but, typically inside, inside just your basic type of call strategy or put strategy out there, you want to perhaps consider a call strategy, reduce risk when you see this Rhodes momentum indicator bottom form out there, or at the high, go ahead and sell some or buy some puts out there. See what else here. You say daily reversal candle. Yeah, I use Japanese candlesticks, Jeff. That's part of what we looked at inside the workshop. So it'll be real helpful to you to review this workshop. I know that you had missed it, or I believe that you had missed it. Do you typically use daily, monthly, weekly charts? I use all three of those. I also, for the futures, so I will show what's going on in futures. So whether it's precious metals, whether it's oil, whether it's natural gas. In the newsletter, we have been in 2019, we were in soybean trades, made nice money there, 3-4 to 1 on that trade. We've been long corn. We've been long oil. We've been long gold. So so in the morning, what I use and show Rhodes momentum indicator signals is for like 30-minute time frames. So I suppose as an example here, real quickly, you asked about the ES Mini. So if I pull over an ES Mini chart as an example, here's a 30-minute time frame chart for the ES Mini. So this is live. This is active. We can see that price has been moving higher with less relative energy. You've got a shooting star. You've got a bearish engulfing candle, and so you've got a top. So I would not be surprised overnight to see price pull back. Well, pull back to where? Well, the levels that I'd be looking for would be 32.71, 32.68, and then that TD9 count breakout area, 32.61.75. So again, these patterns, they will work for all time frames, and inside the newsletter service, you'll see what's going on for those intraday time frames out there. I have a trade room, a chat room for members. TFNN has a trade room and a chat room. So TFNN is the entity that distributes both my newsletter as well as the daily podcast show that I do between 1 and 2 o'clock. Are there levels? I think Chris, are there any questions you see that maybe I overlooked here as they were coming in?
I think that's about it. I think you got to most of the ones that I saw come in.
Okay, good. And look, folks, like if I didn't answer your question or you have further questions or what have you, I'm here as a resource. I am on the East Coast. Please respect my hours. Let me get back here. I'll get you my contact information again, see where that was, or maybe it was on that first slide after all. So you've got my, look, I even gave you my cell phone number. So please respect East Coast hours, which means after 7 o'clock, I'm off duty, so to speak. I'm up pretty early. You've got my Skype, here's my Skype address, steve.rhodes94. And then you've got my email, steve@masteringprobability. So feel free to reach out to me. I'm here to help improve your trading. Simple as that. So, Chris, I guess with that, I'll say thank you, especially thankful to you and the team at NinjaTrader. You guys do a great job. Thanks for allowing me to kick off 2020. And, folks, just be careful out there. There are plenty of signals that suggest that 2020 could be a bear market. What we don't know is, and this week, again, on Saturday, I'll be sending out a update that'll show you the war and how that impacts the market. And you'll really want to pay attention to that. Now, it looks like we've averted a war, but you're going to want to pay attention to that no matter what.
Sure. So thanks to Steve as well for hosting or for presenting the event today. Everyone in attendance here today will receive an on-demand recording of today's event. So keep an eye on that. That would be sent to you via email. The NinjaTrader ecosystem is pleased to sponsor these weekly events as a value-adding service for our clients. If you do see value in these events, we would encourage you to attend on a weekly basis. You can find a schedule of upcoming events as well as an archive of previous events at the following link. We would like to remind everyone that the information provided in today's presentation was that of Mastering Probability and is not that of NinjaTrader. All information was presented for educational purposes and should not be construed as trading advice. Again, we appreciate the time that you spent with all of us today. Enjoy the rest of your day, and we hope to see you again in future webinars. Happy trading from all of us here at the NinjaTrader ecosystem.
Thank you, Chris.